Your income tax wasn't needed. America proved that for 28 consecutive years. The number that stopped me wasn't billions. It wasn't trillions. It was 28. 28 consecutive years. That's how long the United States federal government funded itself, built its navy, expanded its territory, and paid its debts without taking a single dollar from your paycheck. No income tax. No withholding. No April 15th. Nothing. And the country didn't collapse. It grew. It thrived. It became, by several measures, one of the most economically dynamic nations on Earth during that exact window. I found this while researching something else entirely. The Panic of 1893, actually, and the thread kept pulling. The more I looked, the more I couldn't explain away what I was seeing. So I spent several weeks going through Treasury Department records, congressional finance debates, tariff schedules, and the arguments made by the men who built this system. What I found suggests something that almost nobody talks about in the mainstream conversation about taxation. The income tax wasn't an inevitability. It was a choice. And for nearly 3 decades of American history, a very different choice was made, and it worked. Let me be clear about what this is. This is not a political manifesto. This is not a call to abolish anything. This is an attempt to understand what actually happened, what the numbers actually show, and why the story of those 28 years has been so thoroughly compressed into a footnote. Because the part that keeps me up at night isn't the policy. It's the erasure of the alternative. The official story goes like this. The United States Constitution, as originally ratified in 1787, prohibited direct taxes unless apportioned among the states by population. For most of the 19th century, the federal government operated primarily on tariff revenue, taxes on imported goods, along with excise taxes on specific products like alcohol and tobacco. The Civil War forced a temporary income tax into existence in 1861, a wartime emergency measure that expired in 1872. Congress tried again in 1894, passing a peacetime income tax, but the Supreme Court struck it down in Pollock v. Farmers, Loan and Trust Company in 1895, ruling it unconstitutional without apportionment. It took a constitutional amendment, the 16th, ratified on February 3, 1913, to permanently establish the federal income tax. The rest, as they say, is history. That's the accepted framework. Tariffs were primitive and protectionist. The income tax was modern, progressive, and necessary. The amendment was inevitable given the complexity of industrial America. The old system couldn't scale. It couldn't be fair. It had to go. That's the narrative. And it contains real truth. But it leaves out enough that the picture it paints is fundamentally incomplete. Let's start with the numbers, because the numbers are where the story gets strange. Between 1866 and 1893, that is the 28-year window, the United States federal government ran a budget surplus in nearly every single year. Not a modest surplus. In many years, the Treasury was collecting so much revenue from tariffs and excise taxes that Congress was actively debating what to do with the excess money. In 1882, the surplus was so large, approximately $145 million, equivalent to several billion in today's purchasing power, that a special bipartisan commission was convened specifically to figure out how to reduce government revenue. Read that again. A government commission to figure out how to take in less money. Because they had too much. The national debt, which had ballooned to roughly $2.8 billion at the end of the Civil War in 1865, was reduced by more than half by 1893. The Treasury was paying down principal. Interest obligations were shrinking. The United States credit rating, such as it was understood at the time, was considered among the strongest in the world. European bond markets treated American government securities as among the safest instruments available. This was accomplished without taxing income, without taxing wages, without a single dime withheld from a worker's paycheck. The mechanism was the tariff system, import duties averaging between 40 and 50% on a wide range of manufactured goods, combined with internal excise taxes, primarily on whiskey. In 1870, American steel production was roughly 37,000 tons. By 1900, it was over 10 million tons, surpassing Britain, which had been the world's dominant steel producer for a century. That transformation happened during the income tax-free period. The railroad network expanded from roughly 53,000 miles of track in 1870 to over 193,000 miles by 1900. That expansion happened during the income tax-free period. Real wages for American manufacturing workers rose significantly across the 1870s, 1880s, and into the 1890s, even accounting for deflationary pressures and periodic downturns. Speaking of periodic downturns, the official critique of the tariff era centers heavily on the Panic of 1873 and the Panic of 1893, two severe economic contractions that bracketed this period. And that's fair. Those were genuinely devastating events. The Panic of 1873 produced years of deflation and unemployment. The Panic of 1893 was, by many measures, the worst economic crisis the United States had experienced to that point. But here's what matters. Both panics were resolved without an income tax. Both recoveries happened within the tariff and excise framework. The system was stressed. It bent. But it did not require a fundamental restructuring of how the federal government financed itself in order to survive. What changed in 1913 wasn't economic necessity. Something else changed. I want to be fair to the arguments for the income tax, because they were real and they were made by serious people. The tariff system, whatever its revenue virtues, was regressive in one specific sense. It raised the price of manufactured goods, which hurt consumers, particularly lower-income consumers who spent a higher proportion of their income on material goods. A family buying fabric for clothing paid the tariff indirectly through elevated prices. A wealthy family buying European luxuries paid tariffs directly, but the burden as a percentage of income was far lighter. Progressive reformers in the 1880s and 1890s looked at this and saw structural injustice baked into the revenue system. There was also the question of accumulated wealth. The Gilded Age produced fortunes of a scale previously unimagined in American life. Carnegie, Rockefeller, Morgan, Vanderbilt, these men controlled wealth that dwarfed the GDP of small nations. And that wealth, sitting in investments and capital appreciation rather than wages, was entirely untouched by the existing tax system. The argument that those fortunes should contribute to federal revenue was not unreasonable. It was, in fact, compelling to a large portion of the American public. The income tax movement had genuine popular support. It wasn't simply imposed from above. The Populist Party had demanded it in 1892. William Jennings Bryan electrified Democratic conventions with calls for tax justice. The progressive movement that built through the 1900s treated the income tax as a cornerstone of democratic reform. These were not fringe positions. They reflected real anxieties about concentrated wealth and systemic unfairness. Let me be fair to the official narrative. The income tax was not a conspiracy. It was a policy choice made through democratic processes, reflecting genuine popular pressure and legitimate reformist concerns. But here's what the official narrative doesn't explain. The shift in revenue mechanism, from tariffs to income taxes, happened to coincide with something else. Something the history books mention but rarely connect to the tax story. The Federal Reserve was created in December 1913. The 16th Amendment was ratified in February 1913. The same year, 10 months apart. The infrastructure for a permanently debt-financed federal government and the infrastructure for taxing income to service that debt arrived simultaneously. Maybe that's coincidence. Maybe the timing is just what happens when progressive reform movements reach critical mass simultaneously across multiple domains. Maybe I'm seeing patterns where none exist. But the pattern doesn't stop there. Which brings me to what the Treasury records from 1894 to 1912 actually show. The years between the Supreme Court striking down the income tax and there was no fiscal crisis demanding the income tax. There was no revenue shortfall that the existing system could not address. The arguments made in favor of the 16th Amendment were primarily distributive, about who should pay, rather than aggregate. The question wasn't, do we have enough money? The question was, are the right people paying? That's an important distinction, and it's one that gets lost in the standard telling, which frames the income tax as a necessity born of fiscal inadequacy. I spent time with the congressional record from the debates surrounding both the 1894 income tax bill and the 1909 resolution proposing the 16th Amendment. The language is instructive. Proponents of the income tax rarely argued that tariff revenues were insufficient. They argued that tariff revenues were unjust in their distribution. Senator Norris Brown of Nebraska, speaking in 1909, made the case almost entirely on equity grounds. The fiscal sufficiency argument was secondary, almost incidental. Speaking of the 1894 income tax, the one the Supreme Court killed, it applied only to incomes above $4,000 per year. In 1894, $4,000 was approximately the annual income of a successful small business owner or a mid-level professional. It was not a working-class tax. It was a wealth tax in practical effect, even if not in name. The rate was 2%. 2% on incomes above $4,000. The Supreme Court struck it down anyway, in a 5-4 decision that legal historians have described as one of the most politically charged rulings of the Gilded Age. The 4 dissenting justices wrote with unusual passion. Justice Harlan, in dissent, described the majority opinion as a departure from constitutional precedent so severe that it effectively placed the wealth of the country beyond congressional reach. His dissent was not merely technical. It was a prediction that the courts had created a structural barrier to taxing concentrated wealth that would have to be dismantled by amendment. He was right, and the amendment came. But here's what matters about the 28 years that preceded all of this. The period between 1866 and 1893 was not a golden age in the nostalgic sense. It was brutal in many respects. Labor conditions in the new industries were frequently horrific. Child labor was commonplace. The wealth produced by this extraordinary economic expansion was distributed with grotesque inequality. The Gilded Age earned its sardonic name. None of that is erased by the fiscal record. What the fiscal record does show, however, is something specific and narrow: a federal government that funded its operations, reduced its debt, and presided over massive economic expansion without direct taxation of individual income. That fact stands, whatever judgments we make about the social conditions of the era. And the pattern that emerges when you look at what changed after 1913 is at least worth examining. In 1913, the initial income tax rate was 1% on incomes above $3,000, with a surtax reaching 6% on incomes above $500,000. Modest by any modern measure. It affected perhaps 2 to 3% of the population. Most Americans had no meaningful contact with the income tax in its first years. By 1918, 5 years later, the top marginal rate was 77%. 77%. The rate had gone from 1% to 77% in 5 years. The mechanism that was introduced as a modest levy on great fortunes had, within a single presidential term, become an instrument of wartime fiscal extraction touching incomes at much lower thresholds. Maybe that transformation was entirely a function of World War I. Maybe without the war, the income tax would have remained the limited, progressive instrument its architects described. Maybe the rate expansion was a genuine emergency measure with no lasting structural implications. But here's what I couldn't explain away. After the war ended in November 1918, the income tax rates came down. They did, that's true, but they never returned to the pre-income tax model. The federal government did not pivot back to tariff primacy. The infrastructure of income taxation, once built, remained. The withholding apparatus, the filing requirements, the IRS bureaucracy, these things, once created. The part that keeps me up at night is this: the tariff system had a natural constraint built into it. You could only collect so much by taxing imports. That constraint forced choices. With an income tax, a tax on the productive activity of the entire economy, the potential revenue base is theoretically limitless. And so, it appears, are the spending ambitions that revenue base enables. Maybe that was the point. Maybe it wasn't. There are documents in the National Archives, Treasury Department correspondence from 1908 to 1912, that lay out, in remarkable bureaucratic detail, the internal debates about federal revenue structure. Some of these documents have received relatively little scholarly attention outside of specialized economic history circles. The arguments being made internally by Treasury officials in that period do not always match the public arguments being made by amendment proponents in Congress. The public argument, as I noted, centered on equity. The internal Treasury correspondence, at least the portions I was able to review in digitized form, frequently centers on something different: fiscal capacity. The concern expressed in several memos is not that tariffs were unjust. The concern is that tariffs were inherently limited, that the growth of federal programs, particularly pensions for Civil War veterans, which had become a massive expenditure by 1910, was straining a revenue system that could not easily expand. That's a different argument. That's not the rich should pay more. That's we need a revenue system with no ceiling. I want to be careful here. I am not suggesting that the 16th Amendment was secretly enacted for ulterior fiscal expansion purposes, while the equity argument was merely cover. I don't have evidence for that, and I won't claim it. What I am suggesting is that the equity argument, genuinely popular, genuinely just in many respects, may have done the political work of establishing a fiscal infrastructure whose long-term implications extended well beyond what most of its supporters understood or intended. The archive doesn't lie, but it also doesn't always tell you which argument was the real one. Let me return to those 28 years for a moment, because there's a human element to this story that the fiscal tables don't capture. In 1880, an American worker who earned wages, a mill worker in Massachusetts, a carpenter in Ohio, a railroad laborer in Kansas, kept every dollar of those wages. The federal government had no claim on his paycheck. His relationship with federal taxation was indirect. He paid somewhat more for the goods he bought because of tariff-elevated prices, and he paid excise on his whiskey if he drank it. But the concept of the government taking a percentage of his earned income before he even saw it, that concept did not exist in his experience. By 1920, that had changed. Not dramatically for most workers in 1920. The rates were still relatively low on modest incomes, but the architecture was in place. The principle had been established. The income of individuals was now, constitutionally and legally, an appropriate object of federal taxation without limit except political will. That shift, from indirect taxation of consumption to direct taxation of income, is one of the most consequential changes in the relationship between American citizens and their federal government in the nation's history. And it happened so quickly and was framed so persuasively in the language of equity and progressivism that it barely registered as the structural transformation it actually was. Maybe it was worth it. Maybe the distributive justice achieved by income taxation outweighs the structural implications of giving the federal government a theoretically unlimited revenue mechanism. That's a legitimate argument. Many serious people make it. But the 28 years suggests something that the standard narrative prefers to leave in the footnotes. The alternative worked. Not perfectly, not without its own injustices. But the pattern suggests that the 28-year tariff primary era was more fiscally successful than it is usually remembered. The pattern suggests that the transition to income taxation was driven by arguments that were partially, but not wholly stated in public. The pattern suggests that the infrastructure of income taxation, once established, expanded in ways that its original proponents did not predict or intend. The pattern suggests that the fiscal constraint imposed by tariff dependency may have functioned as a form of structural discipline that disappeared with the 16th Amendment. And the pattern suggests that the history of those 28 years, sitting in Treasury records, in congressional debates, in the surplus tables that show year after year of positive federal balances, has been so consistently framed as primitive and pre-modern that most Americans don't know it happened. The archive still exists. The surplus records are real. The debt reduction is documented. The growth statistics are not seriously disputed. What is disputed, what is almost never seriously discussed in mainstream policy conversations, is what those 28 years mean. Maybe they mean nothing. Maybe they were a historical accident, enabled by specific post-war conditions and a particular phase of industrial development that could never be replicated. Maybe the income tax was genuinely necessary for the kind of federal government that 20th century America decided it wanted. Maybe every alternative was worse. But the 28 years happened. And once you know they happened, The story that the income tax was inevitable starts to sound less like history and more like a choice